Greetings and welcome to my channel. One of the things I've retired to is taxes. I'm not an expert, but I'm about to start my second year as a volunteer income tax assistant, which is VITA, and they provide free tax prep for easy to moderate returns, and I get to help people in my local community. Also, taxes have two of my favorite things: numbers and rules. I wish taxes were easier and that most people could just do their own. It would be a simple process, but that's not the case. The rules are extensive and they change every year. One example is the difference between income and long-term capital gains. These are the tax brackets for single filers for both taxable income and long-term capital gains. Taxable income is reduced by the standard or itemized deduction. For single, the standard deduction is $14,600. This means if you have W-2 income and other income that counts the same as earned income, such as interest, less than $14,600, you pay zero income taxes, not including the taxes you pay for Social Security and Medicare. That comes out no matter what. The long-term capital gains rate is a little more complicated unless you only have long-term capital gains and qualified dividends as income. If combined taxable income and long-term capital gains are under $47,025, then the capital gains portion is not taxed. I will show some examples in the next section, so this will hopefully make more sense. These are the brackets for married filing jointly. The income tax rates are just double the single rates, and the standard deduction is $29,200, which is double the single standard deduction. As you can see, the 20% long-term capital gains rate is only about $65,000 more than the single rate. In this example, I'm using married filing jointly with $100,000 in income and $50,000 in long-term capital gains. Notice that line 1 is not $150,000 because it has been reduced by the standard deduction. Line 6 is $94,050, the 0% tax rate for long-term capital gains. If this couple only had a total of $23,250 in capital gains, they would pay no taxes at all on their capital gains. But since they have $50,000, there's going to be some tax on their capital gains. In this example, the remaining $26,750 of long-term capital gains are taxed at 15%. In this example, I wanted to see or show the maximum amount that someone could have as earned income, or a married couple in this case, under 65, could have an earned income and capital gains, or long-term capital gains specifically, before they had to pay any tax. You'll notice on line 1A, I've got W-2 income of $29,200, which matches the married filing jointly standard deduction, which you see down on line 12. This reduces the income down to basically zero and leaves you with the long-term capital gains of $94,050, which is the bracket for 0% taxes on long-term capital gains. And you'll see that on page 2, this results in zero taxes. I also wanted to see for a married couple over 65, how much Social Security benefits they could earn with no other income, but just Social Security benefits. What's the maximum they could earn without having to pay any tax at all, including long-term capital gains? You'll notice the total benefit of $38,000, and again, this is 2024, but $38,000 in Social Security benefits means the taxable amount would be $32,300, and that has to do with all this other income that they have. But capital gain of $94,050, and that gives us a total income of $126,350. We subtract their standard deduction, which is higher because of being over 65, of $32,300. Again, going back, that's why I figured the maximum that would give them only $32,300 of taxable Social Security benefits. We subtract the $32,000, we are left with the $94,050 that we already know is taxed at 0% for long-term capital gains. And that results in no taxes for Social Security and long-term capital gains. So in this case, the total amount that they could earn between long-term capital gains and Social Security is $126,350 before they would have to start paying any tax. Going back to our couple under 65 that had a combined income and long-term capital gains of $123,250, I decided to see how much tax you would have to pay if that was all just income. So if you had $123,250 of W-2 income, for example, in this example, we have our taxable income, as we figured from before, would be $94,050. But since this is income and not long-term capital gains, we have a tax of $10,825. Good bit more than zero. So long-term capital gains, if you can have them as a combination or part of your income, they've got a very favorable tax rate. Keep in mind, there's also Social Security and Medicare tax on W-2 income, but not on short or long-term capital gains. And this includes interest, any investment, dividend income, stuff like that. You don't pay Medicare and Social Security tax on those. Those are just on income. Another thing to keep in mind is that interest and short-term capital gains are taxed the same as income, as W-2 income, ordinary income as it's called. Long-term capital gains are very tax advantaged. It seems the main reason for this is to encourage investments and grow the economy. That's why they decided that long-term capital gains should have a beneficial tax rate to encourage investment in the growth of the economy and investment in businesses. The cynical way to look at it, though, is that the government is punishing income in favor of long-term capital gains. The tax efficiency could be useful for many strategies. So if you're thinking about retirement strategies, which I should have thought about years ago, I've got very little that's in a brokerage account outside of a Roth. If you've got Roth IRA, that's fine because you're going to take money out of a Roth and it's not going to be taxed because you paid taxes on what you put into it. So it's not going to be taxed at the end. But if you have an investment strategy where part of your retirement income is subsidized by long-term capital gain withdrawals, as long as your income's below the levels we talked about in this video, you're in pretty good shape. You could use that as a source of income outside of retirement accounts, so you won't have restrictions. The only restriction is that long-term capital gains have to be held over a year. So if you have long-term capital gains and qualified dividends that fall under this $94,050 cap for married filing jointly, then that's a source of basically tax-free income as part of your retirement. But again, you need to keep in mind the different levels of where the brackets are and how much income you can earn. Because if you earn high income, you're going to end up paying taxes on those capital gains no matter what. Again, though, if you have high income, the capital gains rate is definitely favorable because it's capped at 20%. There are some instances where it goes higher, but there's some special cases where it goes up, I think, to 28%. But for the most part, you're going to be paying a better rate. If you're a very high income earner, you're going to pay a better rate on long-term capital gains than you are going to pay on your income. As always, if you have comments or questions, leave those below. And remember, if you're going to retire to something, retire to VITA and do taxes.